The main news about CELH today is not about the earnings, it's about the acquisition of Alani Nu. Usually, when a company is acquiring another one, the shareholders doesn't like this because you're spending your money to buy another company and the stock price will go down. But in this case, the stock price is going up. So really, is it that such a good deal that CELH is making? I think so. It is a good deal because they are acquiring their main competitor. I would call the main competitor of CELH Monster or Red Bull. These are established companies. Now they are the smaller ones trying to compete to gain market share. And if you look at over the long term, Monster hasn't been doing so well compared to CELH. CELH has been gaining a lot of market share. So CELH, in other words, is directly competing not only with these big two players, but with smaller competitors trying to gain market share from CELH. One of the issues that the market had with CELH a few quarters ago, and that's why the stock price is going down, is because the revenues have not been growing that much. It's because there's competition, and one of these competition is of course Alani. CELH with Alani combined will have 16% of market share. Of course, this is still lower compared to Monster and Red Bull, but there is nothing that prevents these two companies together to maybe in 10 years to have bigger market share than Monster. I see this happening the way they are growing. To acquire a competitor, your main competitor, I believe this is good. But that's not everything because pricing is also important. You cannot acquire at any price. It would not make sense for CELH to pay $10 billion to acquire a competitor. They are paying $1.8 billion. There are some tax benefits they're gaining from this acquisition. So in total, it will be spending $1.65 billion in cash and debt, and also they are going to dilute shares. So CELH has a lot of cash on his balance sheet, nearly $900 million. They don't have much debt apart from leases, and I will also include the preferred shares owned by Pepsi as debt. So these are the debt of CELH, and then they are going to further dilute shares. Let's not forget that Pepsi also in the future may dilute the shares that they own. The preferred shares can be converted into common shares. So there's going to be more dilution into the future. So you as a shareholder of CELH today, you need to look at this deal and to see whether that price you're paying, considering the debt that the company will take, considering the cash that will be used on the balance sheet and the share dilution, whether you're getting more in value for what you're paying. And there are multiple ways to look at this. One way we can do comparison between the two companies. Let's say CELH today is trading at 4.4 times sales and the acquisition they're making is at 3 times sales. Looks like a good deal. CELH is trading at 23 times adjusted EBITDA, and this company they are acquiring is at 12 times adjusted EBITDA. Again, it is a good deal. But I don't like to make such comparisons because at the end of the day, what matters are owners' earnings, the earnings of the company. For example, CELH paid the settlement, so this is included as if it doesn't exist on the adjusted EBITDA. And unfortunately, Alani is a private company. We don't have much information on the earnings and the balance sheet, everything else. But it seems really they have been growing at a faster rate compared to CELH, and they have been eating little by little the market share of CELH. So yes, it is a good company, and they are able to do that with little capital, just like CELH has been doing. And based on that, we can say, okay, maybe they have the same margins as CELH. And looking at Monster, another public company, looking at all of this, I decided that the net income margin of Alani over the long term would be around 10% of revenues. This is lower than CELH. This is lower than Monster. So I'm being very conservative. Alani would be making around $60 million in earnings a year. And we already said that CELH is paying $1.8 billion. So 30 times earnings. It looks very expensive. 30 times earnings. It looks that they are paying for a premium. But we also have to consider that Alani is growing at a faster rate than CELH. They are not just paying for current earnings, but for future earnings. So at 30 times, a company growing earnings by 50% a year, does it look like a good deal? I'm not going to answer this question. I will let you judge. You need to look at the alternatives. And in the case of CELH, what were the alternatives for them? Were they going to buy back shares? Were they going to pay dividends? They could do this, but they are a growing company and it would have been better, of course, to keep growing and acquiring a competitor that directly competes with them and also opening new markets for them. For example, with Alani, the market is more for women. It means that overall, Celsius and Alani together, they can grow at a faster rate. Alani here is going to leverage, just like Celsius, the distribution power of Pepsi, which Alani did not have in the past. And Celsius with Alani together, since they are the same company, they will be able to negotiate with retailers to have bigger space on their shelves. You have to consider all of this. So yes, it is a good acquisition, but I prefer to be conservative, even though they are saying that they will have 50 million synergy on the investment. I don't like to consider this. I prefer being conservative. I prefer to consider that they are making an investment. There are additional costs that they are not even seeing right now. So considering all of this, I believe that it is very, very unlikely that this acquisition is going to deplete shareholder value for Celsius. So if you're paying today as a shareholder 1.8 billion, you are not going to lose that 1.8 billion. This is what I believe. It is very unlikely. How much you're going to make on that 1.8 billion, I look at different scenarios. By the way, you can find everything on the Superinvestors Club. I'm going to post this analysis for free for everyone to see. Let's just have a look how I talk about it. So there are scenarios where that 1.8 billion becomes 2.7 billion, another one 3 billion, another one it remains 1.8 billion. So I look at different multiple scenarios. Of course, we don't know. It's the future. The future is always uncertain. You have to take a margin of safety if you want to invest in Celsius. Today, after this gain in the stock price, I don't consider Celsius to be a good buying opportunity anymore. But if the stock price falls further, I will buy more. Even if we consider this acquisition or we don't even consider it, I believe it is undervalued, but there is no margin of safety today, unfortunately. And I hope the stock price drops so that I can buy more, because it is a wonderful company and I would have wished it was more on my portfolio. Another company that reported earnings yesterday, and if I had the opportunity, I would have put 100% of my money into that company, is Booking Holdings. I will recommend you watch this video next. Have a nice day and goodbye. I'm going for a swim.